Stop, before you tap away, I need you to hear one sentence. The people in charge of protecting your money are no longer sure what is happening to the economy. Not you, not me, them, the Bank of England, the Federal Reserve, the two most powerful financial institutions in the Western world. And right now in May 2026, both of them are operating in the dark in ways that should terrify every single person who has a mortgage, a savings account, a pension, or any money in a bank. Here is what nobody in mainstream media is connecting for you. The Bank of England is privately admitting it does not trust its own GDP data. Think about that. They are setting interest rates for 67 million people based on numbers they themselves believe may be completely wrong. Meanwhile, the Federal Reserve has not cut interest rates in 3 consecutive meetings. Their most recent vote was the most divided since 1992, and the man who has run the Fed for the past 8 years just held his final press conference. A new chairman takes over in 7 days. New chairman, frozen rates, a divided committee, a war in the Middle East that has sent oil prices above $100 a barrel, and inflation, the inflation they told us was beaten, is climbing back up. This is not a crash prediction. This is not panic. This is a breakdown of exactly what is happening right now and, more importantly, what it means for your money. Specifically, concretely, because I am tired of financial news that explains the problem and leaves you with nothing to do about it. So buckle in, because by the end of this video, you will understand something most people in your life have no idea is happening, and that knowledge is worth more than any interest rate your savings account is paying you right now. Let's start in the United Kingdom, because what is happening there is the kind of thing that makes you stop mid-sentence when you first read it. Bloomberg reported yesterday that Bank of England officials are privately concerned that the UK's GDP data may be sending false signals. Now I want you to really sit with what that means. GDP, gross domestic product, is the single most important economic scoreboard that exists. It is the number that tells a central bank whether the economy is growing or shrinking. It is the data point they look at before every single interest rate decision. It is the foundation. And the Bank of England does not believe it. They are not saying this publicly. They are saying it in private conversations, in meetings behind closed doors, 2 people familiar with the matter. Because if they said it publicly, the markets would panic. So instead they are sitting in those rooms, looking at growth figures that look perfectly healthy on paper and quietly telling each other, something is wrong with this picture. Here is the specific worry. UK GDP figures for the first quarter of 2026 are due out next week, and the expectation is that they will look strong, positive, maybe even impressive under normal circumstances. That would be great news, the kind of headline that sends a country's currency higher and gives everyone a reason to feel optimistic. But the bank's concern is that those numbers do not reflect what is actually happening on the ground. Real British households are paying energy bills that have surged since the outbreak of the US-Iran war in late February. Businesses are absorbing higher fuel and heating costs. The mortgage market is still grinding through the hangover of years of elevated rates, with hundreds of thousands of homeowners rolling off fixed deals and on to rates far higher than they budgeted for. None of that stress shows up cleanly in a GDP headline figure, and the Bank of England knows it. So here is the danger. If the data says the economy is strong but the economy is secretly struggling, policymakers make the wrong call. They hold rates too high for too long and tip the country into recession. Or they cut rates too early based on an inflation figure that looks lower than it really is, and inflation surges again. Either way, they get it wrong. And the people who pay the price for that wrong call are not the officials in those meetings. It is you, it is your mortgage payment, it is your savings, it is your job. This is not a minor bureaucratic concern. This is a fundamental breakdown in the information system that drives one of the world's most important economic decisions. And it is happening right now. Now let's cross the Atlantic, because the story at the Federal Reserve is just as alarming, just in a different way. The Fed held rates steady at its April 2026 meeting. That was the 3rd meeting in a row with no cut. The target range is still sitting at 3.5% to 3.75%. And before you glaze over at those numbers, let me tell you what they mean in plain English. That rate is why your credit card debt is expensive. It is why your mortgage costs what it costs. It is why businesses are reluctant to hire or invest. It is the throttle on the entire US economy, and it has been stuck in the same position for months. But here is the part that should really get your attention. The vote to hold rates was 8-4, 824. That is the most divided the Federal Open Market Committee has been since October 1992, 34 years. One official voted to cut rates. 3 others dissented not even about the rate itself, but about the language in the official statement. Specifically, they objected to any suggestion that the Fed would eventually cut rates at all. Let me say that one more time, there are now members of the Federal Reserve who are no longer willing to publicly promise that rate cuts are ever coming. That is how bad the inflation picture looks to the people inside that building. And now here is the detail that makes this even more consequential. Jerome Powell held his final press conference at that April meeting. His term as Fed chairman expires on the 15th of May, that is 1 week from today. His replacement, Kevin Warsh, has been moving through Senate confirmation. He is about to walk into the most powerful economic chair in the world, inheriting a committee that just voted 824, an inflation rate that is accelerating, and a geopolitical crisis that nobody has a clear answer to. Think about what that means. The Federal Reserve, the institution that sets the tone for interest rates globally, is going through a leadership handover at the exact moment it needs the most clarity and confidence, new voices, new dynamics, and markets already deeply uncertain about which direction policy is heading. According to CME Group data, nearly 95% of market participants expect rates to remain unchanged at the June meeting as well. Just 5% are betting on a cut. That is not caution, that is resignation. The people with billions on the line have essentially stopped hoping for relief in the near term. So why is the Fed frozen? Why can't they just cut rates and give people some breathing room? The answer is one word, and it leads us to the third and most explosive part of this story. On the February 28, 2026, the United States entered open conflict with Iran. I want to pause on that sentence for a moment, because if you have been following the day-to-day noise of financial news, it is easy to lose sight of how genuinely extraordinary that event was and how comprehensively it has reshuffled every single economic forecast that existed before it. Within days of the conflict starting, oil prices began surging. The Strait of Hormuz, the narrow waterway through which roughly 1/5 of the world's entire oil supply passes every single day, became a military flashpoint. Brent crude climbed above $100 per barrel. US WTI followed. Energy costs rippled through every corner of every economy that uses oil, which is to say, every economy on Earth. And here is why that is so uniquely dangerous for central banks. There are 2 types of inflation. The first type, demand-side inflation, happens when people are spending too much money. They have too much cash, they are buying too much stuff, prices go up because demand outstrips supply. That kind of inflation, central banks can fight. They raise interest rates, borrowing gets more expensive, people spend less, inflation cools. It works. It is painful, but it works. The second type, supply-side inflation, is a completely different beast. This is what happens when the cost of producing things goes up. When oil is more expensive, when shipping routes are disrupted, when a factory's energy bill doubles, when a truck driver's diesel costs surge. None of that responds to interest rate hikes. You cannot raise rates and make oil cheaper. You cannot hike rates and reopen the Strait of Hormuz. The inflation keeps coming regardless, and the rate hikes just pile additional pain on top of it, making it more expensive to borrow money while simultaneously making everything you buy more expensive too. That is exactly the trap that the US, UK, and European economies are sitting in right now. The Bank of England's own April monetary policy report laid out 2 possible scenarios. In the moderate outcome, oil peaks around $108 per barrel and gradually falls back through 2027. In that case, UK inflation rises but stays manageable. In the severe outcome, oil peaks at $130 and stays elevated for over a year. UK inflation climbs above 6% in early 2027. 6%. After everything that households went through between 2022 and 2024, that number would be devastating. And as of this morning, as of today, May 8th, US naval destroyers and Iranian forces exchanged fire in the Strait of Hormuz again. Peace talks that looked promising earlier this week appear to have stalled. Nobody knows which of those 2 scenarios we are heading into. Austin Goolsbee, the president of the Chicago Federal Reserve, said it out loud this week. Inflation has not continued to cool toward the 2% target. It has actually accelerated since the war began. Until there is clarity on how and when this conflict ends, central banks have no clean path forward. They are not choosing between good options and great options. They are choosing between bad options and worse ones. Okay, you have heard the macro picture. Now let's make it real. Let's talk about your savings account, your mortgage, your bank stocks, and what you should actually be thinking about. If you have a savings account in the US or the UK, the picture is honestly more complicated than most people realize. The good news is that rates have stayed higher than almost anyone expected a year ago. A decent cash ISA or high-yield savings account in the UK is still paying 4% or above. In the US, money market accounts and short-term treasuries are offering similar returns that is genuinely better than the near-zero world of 2020 and 2021. But here is the catch that nobody talks about enough. If inflation climbs back toward 5% or 6%, which the Bank of England's own severe scenario projects as a real possibility, earning 4% on your savings means you are losing purchasing power every single month. Your balance grows, but what that balance can actually buy shrinks. Faster than the interest accumulates, that is the quiet erosion that destroys wealth without anyone ever breaking in and stealing anything. For mortgage holders, the situation is more immediately painful. In the UK, an enormous wave of homeowners are rolling off fixed-rate deals throughout 2026 and into 2027. These are people who locked in rates of 2% or 3% several years ago, and they are now remortgaging into a world where comparable deals are sitting at 4.5%, 5%, even higher. For someone on a £250,000 mortgage, that difference can mean paying £500 to £800 more every single month. That is real money. That is holidays cancelled. That is savings accounts emptied. And with the bank rate going nowhere fast, there is no cavalry coming. In the United States, the housing market has essentially frozen. People who locked in 30-year mortgages at 3% in 2020 and 2021 are not moving because moving means giving up that rate and taking on a new one that could cost them thousands more per year. First-time buyers are locked out of a market where the monthly payment on an average home has become genuinely unaffordable on an average income. And all of this distress is sitting on the balance sheets of the banks that issued those loans. Which brings us to bank stocks. If you hold shares in J.P. Morgan, Bank of America, Barclays, NatWest, or any major Western lender, here is the honest picture. High rates have been good for bank earnings. Banks make money on the spread between what they pay depositors and what they charge borrowers. That spread has been wide. Profits have looked solid. But sustained high rates come with a delayed cost that is starting to show up. Loan defaults are climbing. Credit card delinquencies in the United States have been rising every quarter. Commercial real estate, the office buildings, shopping centers, and mixed-use developments that banks are heavily exposed to continues to deteriorate as remote work reshapes demand. And if the Bank of England is right that the UK economy is secretly weaker than the GDP data suggests, British banks could be sitting on bad loans that their current valuations do not reflect. None of this is 2008. The major banks are far better capitalized today. Regulators have spent 15 years building buffers for exactly this kind of stress. A systemic collapse is not the scenario here, but a prolonged period of hidden pressure, slowly rising defaults, and policy decisions made on faulty data that is a scenario that quietly erodes the value of every financial asset you hold. And it deserves your serious attention. Here is what I want you to walk away with today. The Bank of England is questioning the data it uses to set interest rates for 67 million people. The Federal Reserve is more internally divided than at any point in over 3 decades, and it is about to change leadership in the middle of a crisis. Energy inflation driven by a live military conflict is making every economic model less reliable. And the people running these institutions are not hiding this. They are saying it in press conferences, in private meetings, in policy reports. They are just saying it in language that the mainstream news cycle doesn't slow down long enough to translate. So consider this your translation. Your bank is not in danger of collapse, but the system that is supposed to guide it, the data, the leadership, the policy clarity is under more strain than it has been in a very long time. And in that environment, the most dangerous thing you can do is assume that someone upstairs has it all figured out. Because right now, upstairs is divided, uncertain, and about to change hands. What does that mean practically? It means you pay closer attention to your fixed-rate deal expiry date. It means you think harder about whether your savings are keeping pace with real inflation, not just the headline number. It means you hold bank stocks with a clearer eye for what elevated rates are doing to their loan books, and it means you keep watching this Story, because the next 6 to 8 weeks, the new Fed chairman, the UK GDP release, and whatever happens next in the Strait of Hormuz are going to tell us a great deal about which direction we are all heading. If this video helped you see something you weren't seeing before, share it with one person who needs to hear it. That is the most useful thing you can do. Subscribe if you are not already, because we cover exactly this kind of under-translated financial news every week. And drop a comment below with one question. Do you think the Federal Reserve will cut rates before the end of 2026? I want to know what you think. I read every single reply. See you in the next one.